Hello, members of the Tennessee Society of CPAs. It's me again, Tom Landstreet. Many of you have seen me before, and I'm going to try to fill this time with interesting observations, charts, data, commentary, some predictions. And of course, as usual, if I'm right about my predictions, I want to get all the accolades, and if I'm wrong, I just don't want to hear about it. Is that a deal? Um, so I love doing this for you all for some reason. Accountants get what I do. I speak to a lot of accounting firms. I was just speaking to 600 international tax accountants recently. And half of my presentation, I originally prepared for this global minimum tax movement that was underway, but that has now clearly been scuttled by the US election. I don't think that's something Donald Trump's going to go for, which would be relinquishing our sovereignty to another global bureaucracy. And I don't think we should do that. I think that there should be tax competition. Just like our fair state of Tennessee is booming relative to other states, just like our fair state of Tennessee is attracting so many residents from California and Illinois and New York. They're tax refugees and they're coming here for our 0% income tax and our pro-business environment. And also because we're just a friendly place full of smart, attractive people. That might be it, but I really think it's just economics. I'm from Nashville, so we're being overwhelmed by Californians, as you probably already know. Hopefully, they won't destroy the state like they have their own. So once again, I'm very happy to be doing this, and I've invested a lot of time in the Tennessee Society of CPAs over the years. I've given many talks, most of them for free. And I have written articles for the journal, the Tennessee Society of CPA Journal, which I enjoy doing. And so I've invested a lot in our relationship with you all. Really, all I ask for in return is, after investing so much, is that I hope that if you have any clients that are disgruntled with their financial advisory uh, assistance, if they are looking to upgrade their wealth manager, that you might consider us. We are a fiduciary by law, which means that we are actually culpable if we make errors or if we are not sterling in our advice and our processes. So we put ourselves at risk. We eat our own cooking. I run a fund and a global macro hedge fund. I have a small research staff. We research companies, we research commodities, we research interest rates around the world and government policies. So we have several things that are interesting for a small and growing Tennessee firm. We have very experienced wealth management staff. We have really unique research ideas, and we have a real customer friendly focus. So that's my pitch, and I really would appreciate it again if your clients are in need of anything like this, that you think of us. We won't let you down. So here's my disclaimer. Because I'm a fund manager, I have to say this isn't investment advice and do your own work and so forth. But the biggest disclaimer is because a lot of what I do is analyzing government policies and their incentive effects on behavior, really, in the economy and prices, that you understand that because I deal in policy in this discussion, it's political, but it's not partisan. And I can prove now and again that neither party has a monopoly on bad ideas. I'm a student of economic and policy history, and I'm appalled at both parties, honestly. So now that I've cleared that, here I am. This is our website, trustcomgmt.com. If you're curious, there I am, and there's my bio. Here's my partner and childhood friend, George Smith. He's got a CFA and an MBA, and he managed hundreds of millions of dollars for both institutions and individuals. When I was at Robinson Humphrey, a now defunct or now acquired White Shoe Investment Bank, um, he managed the SunTrust pension. So we're dear friends. He's my partner, and I just want to introduce us. In case my money management gig falls through, I'm a musician and I'm a band member of the Cameroons. And these gentlemen all have played for Grammy-winning acts, except me. I am a global macro hedge fund manager, but there I am in the back, and you can see me standing up. That contraption is something I made in college. It's a washboard, but it's not any washboard. It's got cymbals attached to it, a snare, custom-made snare. As you can see, I'm standing up but kicking a kick drum, a bass drum, and I have, if you look very closely, electronic tom-toms and an electronic cymbal. So from the audience standpoint, it looks like I'm playing this goofy washboard, very Nashville. But the truth is, it sounds just like a drum kit. It's got all the bells and whistles. And this picture was taken in Greenwich, Connecticut this summer, playing at the Greenwich Town Party. And we were opening for an amazing act called Mumford and Sons. And so that was a thrill. And so that's me. That's my hobby. And then you know what I do for a living. Let's talk about you. Let's talk about accountants. I saw this. I've seen a lot of statistics about the number of accountants falling, the population of accountants. And so what I would urge you to do is go to your boss today and ask for a raise, because in economics, scarcity leads to higher prices. And so I'm here to empower you, if you will, embolden you perhaps to ask for a raise because you deserve it. And here's one of the reasons. Because tax complexity continues to pile up. Honestly, I think that's by design. I think the government gains a lot of power from having a complex tax code, but it's very burdensome to businesses, but very lucrative to you. So here's another reason for you to ask for that raise. Wouldn't it be nice for the rest of the world to just have a flat tax, one tax rate? And that was all about what the Laffer curve was about. As you may know or may remember, I had the honor of working for Arthur B. Laffer, the creator of the Laffer curve, a PhD economist from the University of Chicago, where he tutored under the great Milton Friedman. And he was part of the Reagan Revolution. Ronald Reagan, as you know, came into office in 1980, and he enacted a major tax cut in 1982. And my old boss, Arthur Laffer, was instrumental in designing that tax cut and, more importantly, selling that tax cut across Capitol Hill. The legend has it that Art Laffer, with his notebook in hand, called on every senator and almost every congressman, mano a mano, to pitch Reagan's plan. He did it personally, and he has an amazing rhetorical gift. He has logic and reason and data, and he was very important in getting this mammoth tax reform passed. And I'll give you an idea of how important this tax reform was. When Ronald Reagan came into office, the highest marginal income tax rate was 72%. So a prosperous worker, business person, was lucky enough to keep 28 cents of every dollar they earned. Of course, there were lots of exclusions, lots of tax loopholes. The higher the tax code, the more complex the tax code, oftentimes the more loopholes are available. And so America's smartest citizens, their most prosperous citizens, most creative, ambitious, spent their time not growing and hiring their businesses, but rather evading and avoiding high tax rates. And that was the problem of the whole 1970s, in fact. And my father was one of them, by the way. Um, you may remember the tax loopholes that involved rich people, a lot of them doctors, buying real estate, commercial real estate through limited partnership interests, with the whole business model was designed to lose money. And if they lost money, then they could report that loss against their income and reduce their taxable income. So again, when I say that this Byzantine tax structure in the 70s with the 72% highest marginal rate, when I say that it was disruptive, it's true, but it was a massive disincentive to work effort. And again, it incentivized our smartest and most creative and ambitious citizens to not grow their businesses, but rather to invest their time in shrinking their businesses and creating false losses. And what an amazing diversion of creative energy. It probably cost some percent of GDP, but either way, my old boss Arthur Laffer, creator of the Laffer curve, which of course studies the dynamic effect of tax rates on behavior and prices, and specifically on income to the federal treasury. I had such a great time working with him. And Arthur taught me about the four grand kingdoms of macroeconomics. And this is his construct for analyzing government policies, all government policies, all of them. You can fit them all into one of these four grand kingdoms. There's monetary policy, which is, of course, the analysis of central banks, the Federal Reserve, the European Central Bank, the ECB, the Bank of Japan, the Bank of China. And of course, these entities are in charge of money, money supply, interest rates, and banking regulations. Exceedingly important, especially in today's economy and in the markets. Fiscal policy, which is tax rates, they govern tax rates, tax credits, stimmy checks, depreciation rules, which you all deal with quite a lot. And it falls under the rubric of the Treasury Department. By the way, the Treasury Department has something like 80,000, maybe 100,000 employees. The Treasury Department. So as you know, Elon Musk and Vivek Ramaswamy have been ordained by President-elect Donald Trump to go after federal spending through this DOGE concept, the Department of Government Efficiency. And my guess is they could cut a lot of fat before hitting muscle. I would say start with the 100,000 idiots that are in the Treasury Department. And I hope that doesn't offend anybody. Trust it doesn't. Trade policy is the least appreciated of the four grand kingdoms. This is free trade versus trade wars. And of course, this is a very hot area today of concern. And then there's regulatory policy, which is requirements and restrictions of any type. It really encompasses all policy that is not in the other three grand kingdoms. What does this include? Building safety codes, food safety codes, the ethanol mandate, for instance, the minimum wage, and it's huge. So whenever you increase regulations, just like increasing taxes, if you tax something more, you'll get less of it. If you regulate something more, you'll get less of it. So these policies have a tremendous effect on behavior and prices. And honestly, I'm very worried about inflation, not now, but over the next decade. And I'm going to go through that. It's my top concern. And I wouldn't be so nervous about it if I hadn't embarked on a massive research project when I was working for Arthur Laffer. I ran research. I had several PhD economists under me you saw me playing that washboard. You know me. Isn't it interesting to know that I had PhDs underneath me? I don't have a PhD nor a master's degree, but Arthur Laffer liked it that way. And part of the reason he liked it that way, believe it or not, even though he's a PhD from Stanford, is that he did not respect PhDs. He thought they were way, way too complex. He thought they invented ghosts and goblins that didn't exist. He would tell you that a PhD economist is trained to encapsulate the entire economy, perhaps the world economy, in a static math formula that looks like hieroglyphics. But he would like to simplify that. He would like to simplify the study of economics and the study of economies. He would frequently say to me, Tom, if it works in an economy of two, it works. What that meant was between you and me, you as an individual and me as an individual. If an economic policy worked between us two, then it likely worked across a broader population, the country, the world. And specifically, it's regarding trade, which I'll go into in a moment. So back to the fact that I was running research with several PhDs, I was shocked at how little they knew about the stock market, for instance, which is my world, and reality. But they were great researchers. So we embarked on a nearly year-long project to analyze what happened during the 1970s, the stagflationary period that you might be too young to remember, but certainly your parents complained about it around the dinner table as my father did. I heard about it my whole life. My father was an investment banker. He was in my business. But the 70s were miserable. And I'm the youngest of five, and dad would make us sit at our dinner table until we ate every last bite of spinach. That's the kind of family I came from. He was a Marine. And we had to hear him complain about, he was very Southern. He would say, Johnson, Nixon, Ford, and Carter, the four stooges, and pound the table. And I heard that about that my whole life. What that did was, first off, it was the first sign of bipartisanship that I'd ever heard. There's two Republicans and two Democrats in that crowd. So my father, through saying that repeatedly, created in me a skepticism about government in general, politicians in particular, and parties for sure. So I was cleansed of partisanship early in my life. And another thing was it created in me a curiosity about what happened in the 70s. What created this 12-year period of time where prices rose like 20% and the economy did not grow at all. And if you look at the Dow or the S&P, specifically the Dow, it was the bigger of the indexes, it went nowhere for that whole period of time. Like, what causes that in this world, especially in America, which is a free market capitalist construct? In a pure free market economy, there are no booms and busts and bubbles. There should not be wild inflation. Prices adjudicate supply and demand in a purely free functioning economy. But there are bubbles, and there was a long period of stagflation, which is again low growth and high inflation. Again, back to the markets. If you own $10,000 worth of equities in 1968, by the way, they refer to the 60s as the go-go 60s for a reason. John F. Kennedy, a Democrat, was a tax cutter. Can you believe that he cut tax rates from 94%, the highest marginal rate post-World War II, to 72%, and that was accretive to growth in the United States? Those numbers are hard for us to even contemplate, but they're real. Anyway, JFK, Democrat, was a pretty pro-growth president. And of course, with the World War II veterans coming back, starting their families, I'm one of five. It was a baby boom generation, obviously, and it was a very productive time. Stock market roared in the 60s, the go-go 60s. And then Richard Nixon was elected president. Back to the markets. If you own $10,000 worth of US equities in 1968, by 1982, when Ronald Reagan was enacted his tax cuts, by 1982, that $10,000 was worth about $2,750, inflation adjusted. So the purchasing power of the monetary unit, the dollar, collapsed that much during that period. And you know what investors and business people and Americans got for that? Zero growth. And if you look at the stock chart of the Dow, for instance, going back that period, you'll see that it rose 60% and fell 60% during that period. It went absolutely nowhere, but once again, inflation adjusted, your gains were wiped out. I think we're entering a period that could be very like that again. And I know that some of you all have heard me say this. I'm constantly, as a fiduciary for my clients, some of which are probably your clients, actually. I know in some cases they are, for Blankenship, my accounting firm, who I love. As a fiduciary, I'm constantly looking for confirmation that I'm right, but probably more importantly, countervailing evidence that I'm wrong, so that I can make sure I'm doing the right thing for my clients in regard to our investment strategy. And I just keep seeing more and more evidence that I'm correct on this stagflation prediction, that over the next decade, we're going to see an awful period of time. There are a lot of things that could change that, and I'm going to go through them. And certainly Donald Trump is one of them. And certainly the Department of Government Efficiency is one of them. But net is I'm sticking to the prediction of that we are going to be facing a stagflationary period. And I'm going to go through that in detail. So let's have fun. As you may have read my articles for the Tennessee Society of CPA Journal, I've written two. That 70s show, Economic Reruns, could be on the air for another decade. This article and this article, the two I've written on this topic, which I highly recommend you read, are the result of that deep dive I did at the Laffer organization with those two PhDs in what created the 1970s stagflationary period. When I first got in this business, the investment business, as an institutional investor, it was very rare for a company to report anything other than GAAP earnings. Every once in a while, they would report pro forma earnings, or they'd have an adjustment, a one-time adjustment. But then those one-time adjustments started happening with greater frequency. Now that's it's all they do is report adjusted earnings. There are no earnings anymore other than adjusted earnings. And it requires a guy like me, somebody who knows how to do it, to dig in and find out what the adjustments are or were. And they vary between companies, between industries, and between earnings reports. The numbers that these companies are reporting are, I would argue, not real, and yet the market reacts to them. So that's a complaint I have, that it's hard being an investor like us because we need the truth in order to be fiduciaries for our clients. But I'm going to come out with another article here shortly, and to your delight, I'm sure. Anyway, so let's go back to inflation. Inflation is too much money chasing too few goods. Milton Friedman is famous for a number of phrases regarding inflation. One of them, the most famous one, is that he says it's always and everywhere a monetary phenomenon, which means it's related to money supply alone. I would argue, and I discovered this through the 70s, is that there's two sides of the equation. It's not just too much money, it's also too few goods. And I came across this revelation again studying the 1970s and what caused the great inflation. I have a chart that I've showed at many speeches to the Tennessee Society personnel and membership. And I wish I had it here. Forgive me for not. But it shows the U.S. oil production. Richard Nixon, let's go back in history. Remember the go-go 60s. We went through that. JFK, Democrat, tax cutter, pro-growth 60s. And then here comes Richard Nixon, a very political, one of the most political presidents in modern history. By the way, his administration is thought to be the most intelligent administration in modern history. And I'll argue right now that they were not intelligent at all. I mean, maybe they were book smart, but they certainly had no common sense. So Richard Nixon was very worried about inflation because during the 1960s, the go-go 60s, the latter 5 years of that decade, oil prices were rising rather substantially as the U.S. industrial production increased at high single digit levels. So GDP was growing 5+% during that period of time. Can you imagine how great that would be? And oil prices, which was oil as a percent of GDP, was a much more important input cost. In other words, we consume more barrels of oil per unit of GDP than we do currently. So oil was a massive input cost to the broad economy. Oil prices were rising, and he was very worried about it for his political career. So he enacted price cuts, price caps, if you will, price controls, and he used a complex scheme of excess profits tax regulation to do it. And what this did essentially was the United States was the largest producer of oil in the world by far at that time. Saudi Arabia and the United Arab Emirates, Iran, Iraq, the Middle East producers had just really discovered oil, honestly. And they didn't discover it. Exxon did, then called Esso, and Shell and Chevron. U.S. companies discovered oil in the Middle East, invested millions of dollars in infrastructure and to get the oil. And so the oil industry in the Middle East at the time was in its infancy. Oil prices were rising dramatically. The United States was by far the largest producer at the time. OPEC, which we all know is a price-fixing cartel, hadn't even coalesced into a cartel at the time. It was really just kind of a loose selling group at the time. And most of the world's oil, like 90+%, was produced by 4 states: Oklahoma, Texas, Pennsylvania, and Alaska. U.S. oil production had been rising steadily since 1925, when John D. Rockefeller found a great way to distribute oil, and he supplanted whale oil. You may know that story. It's amazing. U.S. oil production had been rising steadily since 1925. In the late 60s, it's gapping up. U.S. oil production almost goes parabolic. And again, Richard Nixon was very worried about inflation, so he capped what U.S. producers could charge per barrel below the prevailing market price. So let's pretend that you all represent the CEOs of America's extraction industries, oil and gas industries. And I told you, as President Richard Nixon did, that I'm going to cap what you can charge per barrel below the current price. You think about this 1 second. Where's the incentive to go get that marginal barrel of oil when you can't charge the price that the market is paying? Well, the answer is the incentive collapsed. And if I could show you the chart of U.S. oil production during that period that I said, 1925, parabolic in 1966, 7, 8, 9, 10, 1970, and the day that Richard Nixon enacted those price controls, U.S. oil production turned and collapsed and went through a 40-year decline. And it only started up again when fracking was invented. Fracking, as you know, is this unique way of finding oil in shale formations. And the only reason fracking was invented, and the only reason fracking came to save the day, is because it occurs on private lands and the government can't stop it. The government had been leaning on the oil industry for all that period of time, the whole 70s. And by the way, Nixon's price controls failed miserably, of course. As U.S. oil production collapsed, the price shot the moon and made inflation much worse. And by the way, emboldened OPEC to evolve into what they are today, a price fixing cartel. They gained more power over the market, and it emboldened them. And by the way, they kicked out U.S. oil producers out of the Middle East. I told you that Esso, Chevron, and Shell had found that oil in the Middle East and started exploiting it. They just took those resources away from those Western companies and kicked them out. They took over the wells, the infrastructure, literally stole it. And then they, of course, emboldened by the high and rising price of oil, which wouldn't have been a problem if Nixon hadn't tried to cap prices. With all that power, they basically became the market. That's the story of OPEC. We caused it. We did that. Government policies, regulatory policies by a Republican president by the name of Richard Nixon. And that was exacerbated by the Yom Kippur War, which you've probably read about, at least tangentially. And that was when Israel, got into a skirmish in the Middle East, and we backed Israel, which was unpopular among the Arab nations. And so we have U.S. price controls mixed with a geopolitical schism, if you will, and the rest is history. Prices rallied crazily, scarcity ensued. When I was a wee lad in Nashville, Tennessee, my mother had to get gasoline on odd days, and our neighbor got to get their gasoline on even days. You may remember that. Gas lines, odd day, even days. And that shouldn't be happening in a freely functioning capitalist system. In fact, it couldn't happen in a freely functioning capitalist system, but we don't have that, and we didn't have it then. So that's the story. That's the story of the beginning of the inflationary, stagflationary 1970s. I'll go one step further to tell you about Richard Nixon, and I'll remind you once again, he's considered, or his administration is considered, to be one of the most intelligent in modern history. Just because they have Harvard degrees or PhDs doesn't mean anything, as Art Laffer reminded me many times. Of course, his price controls in the oil patch didn't work. Oil prices skyrocketed, and he was frustrated. So then he imposed a 90-day moratorium on all prices in the whole U.S. economy. All prices, everything. So I know your head is exploding on that concept. Look, I just want you to see my nice outfit. What does that mean? How do you do that, you might ask? I hope you're asking in your quiet time, in your living rooms there. He was emboldened because his price controls in the oil patch didn't work, and so he imposed a 90-day moratorium on all prices. So let's go through an exercise real quick. Let's pretend that I import iron ore from Brazil, and I sell it to Karen Eversman, who creates a value-added steel product, who sells it to C.J. Blankenship, who creates an auto part out of it, and he sells it to Royce Ray, who works at Blankenship, who is an auto manufacturer, who sells it to someone else who's a retailer, who sells it to a consumer. It's like 6 or 7 transactions that occur during that supply chain. Nixon froze all prices in the entire U.S. economy, so all 6 or 7 participants in that supply chain had to freeze their prices. And by the way, he did this. It was a 90-day moratorium on price increases. He funded and staffed a bureaucracy in Washington to monitor it. And everybody in that supply chain, me, Karen, CJ, Royce, had to fill out paperwork and prove that we're compliant. Now, what did that do? It gummed up the entire economy. Everybody stopped producing and inflation took off again. So never underestimate the stupidity of the smartest people in government. That's proof of it. By the way, there's a great book on this period. It's by Amity Shlaes, Schlaes, Amity Shlaes. It's called The Great Society. It's really about Lyndon Johnson, who preceded, as you know, Richard Nixon, but who set off the social spending binge that was the too much money part of the inflation. Nixon was the too few goods part of inflation, and together you got the stagflationary grind of the 12-year period up until Ronald Reagan was elected and enacted his tax cuts. So Democrat and Republican. It's a great book, and again, it's called The Great Society. I highly recommend it. So that's the story of price controls. That's the story of regulatory policy. And that's the story of too few goods. So once again, going back to Milton Friedman's concept, inflation is always and everywhere a monetary phenomenon. No, not in my opinion. Not after doing the deep dive in the 70s. Inflation is too much money chasing too few goods. It's two sides of the equation. How do you get too few goods? Lots of ways. And I'm going to go through some of them. One of them is price controls. Of course, Kamala Harris, who right before the presidential election comes out with this incredible idea to cap prices in the grocery sector. And of course, everyone across corporate America, even noted CEOs who are Democrats, reacted negatively. Why? Because of what Richard Nixon did. If you look at grocery company gross margins, they're single digit. I mean, they operate off like a 3 or 4% gross margin. So to cap prices would be disruptive. Hey, we wouldn't have enough food, like they didn't have enough oil. Can you imagine having to go to Publix on an odd day and your neighbor gets to go to buy food on an even day, like they did oil when I was a boy? I'm not kidding. There's risk to that kind of stuff with price controls, and that's a fact. Europe's imposing them now, and they're coming apart at the seams. So there you go. There's my equation of inflation. We only have an hour left. You need to drink a little water? I'm just getting started. This is fun. I may go 2 hours. Okay. CPI, a bogus metric if there ever was one, by the way, called consumer price inflation. And you can see here where it's just gapping up. I mean, that's extraordinary. Why is CPI bogus? Because a lot of reasons. One is it's manipulated by the government. Surprise, they want inflation to appear lower than it is so that they can retain their power. Yes, I'm a conspiracy theorist, but I've got data to back it. Here are some of the things they do. One, they make these numerous adjustments, and they change the adjustments every other year or so. And an example would be if ground beef increases by 100%, they're going to assume that we trade down to chicken. So they actually lower the contribution of beef to CPI by some amount, assuming that we trade to the lower cost alternative chicken. That's an example of one of the adjustments. They make hundreds of them. And again, they change them all the time. In the early 90s, CPI was simple. They would take a basket of 100 goods. It might be an automobile, a house, beef, gasoline, lawnmowers, 100 items fixed. And they analyze what these items cost year over year. That was that, and that was inflation. Now they make these incredible adjustments, so there's really no way to get a fix on inflation. Either way, there's the number. By the way, a great source of data, if you're a geek like me, is to go to Fred. This is what this is. Fred. right here. This is the St. Louis Federal Reserve, and they have data on everything. I mean, literally, you can find out how many blue and white checkered shirts like this are in existence by going to Fred. I mean, it's really extraordinary. So I highly recommend it if you're interested. Um, I'm making a bold prediction on inflation that I think it bottomed in June of this year and is going to tick up, and I think it's going to be the story of 2025 for stock investors, bond investors, and even CNBC. And if I'm right, then the biggest risk to this stock market bubble, I would argue, is a disorderly rise in bond yields here, which would be the result of naggingly high inflation, which again I'm predicting. To repeat, if I'm right, I want all the accolades. If I'm wrong, I don't want to hear about it. Please, thanks. Here's what got Donald Trump elected. The light blue line here is Main Street inflation. This is the price level itself, the dollar amount of inflation, and it's continuing to rise. Prices are rising, as you can see here. This is the dark blue line is Wall Street's definition of inflation, and that is the percentage gain year over year, which has fallen from 9% to 2.8 or 9% here. So on CNBC and in the Wall Street Journal, the New York Times, they crow that inflation's subsiding, it's going to return to the Fed's 2% goal. We're all good. But Main Street has to pay more prices because prices still are up almost 3% versus last year. And since COVID, like up 20 something percent. So this is what is the problem. My old boss, Art Laffer, used to call inflation the widowmaker, politician's widowmaker, he said. In fact, it took down Richard Nixon. He's known for Watergate, but his policies took him down. And inflation is what took down the Democrat Party in the last election, honestly. That was it. I'll go through this a little bit more. The Forgotten Man is another great book I would recommend to you. Written by the same writer, Amity Shlaes. This is like a proctology exam of the Great Depression, a scope. She digs in to the policy mix that created, deepened, and prolonged the Great Depression. And it is such a great read. First off, it's well written. It's an easy read. Second off, the policy ideas that they pursued make Richard Nixon look smart. Oh my goodness. If they had been more simple, if they had thought when they enacted a policy, if it works in an economy of two, it works, they would have never done anything that they had done in the 30s under FDR. This book I highly recommend it. The policy mistakes they made in the Great Depression were so egregious and so stupid that when you're reading it, you just can't believe your eyes. And by the way, she has a cadence to her writing to where it's almost like a boxing announcer. It's a page turner. It's like, they did this and that didn't work. It made things worse. So they did this and that didn't work. And then they did this. And any thinking rational person is just like drawn into the drama. Unfortunately, it was real. It led to significant misery. My mother was born in 1923. I know I look so young, but she was in her 40s when she had me. But when she was 7, the Depression started. 13 years of the Depression. So when she went to Vanderbilt as a freshman, all the boys left town to go to World War II, which lasted 5 years. So my mom and her generation had a abnormal life until their mid-20s when things returned to normal. None of it was necessary. When I say that I learned this from The Forgotten Man, the book by Amity Shlaes, but here's an idea. They were very worried about prices collapsing in the 1930s. deflation. And we were largely an agrarian economy at the time, which obviously means that we were a farm economy still. The Industrial Revolution had started, was underway, yes, but we were still largely an agrarian economy. They were very worried about food prices collapsing. They were collapsing. So in order to put a floor on food prices, the geniuses from Washington and Franklin Delano Roosevelt's administration sent federal agents out across the fruited plain from Washington to confiscate and kill 600,000 head of swine. As you know, as a source of protein, pork is the cheapest. Beef is much more expensive. So most people ate pork. In the poor societies of China, for instance, in India, they eat a lot of pork. Why? It's a cheap source of protein, much more abundant than beef. Why, you might ask? Well, because a pig has 6 to 9 pigs in a litter, and they have 3 litters a year, and they grow quickly. That's the main reason. And as you know, a cow, it has a 9-month gestation pregnancy, and they have one cow, and it takes 27 months to have a harvestable cow. So just by virtue of those two things, pork is much more important, especially in economies that aren't just rich. Either way, pork was a big part of the diet in the 1930s, and they were worried about deflation. So again, they confiscated and killed 600 head of swine in order to put a floor in prices. Can you imagine them knocking on your house? Farmer John, we need to see your livestock. And they take them and kill them. It wasn't long after that that we had a drought, a nasty drought, which led to the Dust Bowl. And all those pictures you see of the well-dressed but dirty gentlemen lined up with tin cups, that was the result of that policy. These are the smartest people in our culture. You should doubt everything they do and say. So back to the forgotten man. How did Trump get elected? This is Dollar General stock, and this is Ferrari stock. The ticker for Ferrari stock is RACE. Check it out. All-time highs. This is a good example of the class division that is occurring under this money printing regime that we are currently in. And this is the dichotomy in outcomes among the middle and working class versus the rich that created, that basically gave Donald Trump the victory. Here's another problem with CPI. 30% of CPI is home prices, and they get this data by calling homeowners and asking them in a survey what they think they could rent their home for this month versus last month and versus last year. So let's pretend again that you are called by, I guess it's the Bureau of Labor Statistics, the Commerce Department that does this survey. How would you answer that question? I mean, I study this stuff for a living, and I wouldn't know how to answer it. What could I rent my house for? I don't rent my house. I live in my house, and I have for 22 years. In other words, they're calling homeowners, not professional landlords, and they're asking them a question about what we could rent our house for. To say the least, this is unscientific. Would you agree? And yet it's 30% of the CPI. So when CPI comes out, which it will next week, always the middle of the month, and CNBC goes bananas about the number, Wall Street Journal, they all bleed about it. It's a bogus number, but it still bottomed in June. And my suspicion is it's going to tick up from here, and it will be the story of 2025. So there you have it. In the last CPI, October, you can see the red line here gapped up a little bit. So again, I'm thinking that CPI bottomed here in June, and that it's ticking up, and that it is going to be the story. As far as the 1970s, and the analog that I see today. The red line is the current trajectory of CPI inflation, and it shows in the COVID crisis era, it's gapping up to here, and it comes back down as it recedes. Remember, we had a problem with the supply chain. Remember, there were cargo ships lined up off of the port of Los Angeles and Long Beach and off the ports of Shenzhen, China, and Shanghai, the four biggest ports in the entire world. So that reflects that. But of course, as things normalize, you can see the red line. You can see CPI come down, but it stops going down, and it's not going to the prior levels pre-COVID. And my guess is it won't. So back to that price level, this is what is hurting consumers who aren't Jeff Bezos. And the same thing happened in the 1970s, by the way. It gapped up significantly and then came back down. They cut rates too early, and then it ripped higher all the way at 15% in the 1970s. So the right-hand scale is the 70s, by the way. You can see that it's like more than 14%. It was like 17 or 18% when it got up to that second peak. My guess is that we're going to see the same trajectory of inflation. And I would say that, well, I'll try to keep you posted if that scenario changes, because it's going to be very important. If it does follow this path, what it means is we're going to see high single digit, perhaps double digit interest rates into the end of this decade and into the next decade. So let's do a little exercise here. You've got stocks and bonds, you've got your house and your business, and you've got your customers and their businesses. Who's considering the policy that the possibility that we have high single digit interest rates in just a few years? No one that I know of. It's certainly not the narrative anywhere that I can detect, but it is a distinct possibility. And it's very important to maybe not react to this now, but it's important to know that it's a risk. And when we analyze our clients' portfolios, we help them look at their businesses. We help them look at where their investments are across the spectrum of risk, from real estate to stocks to bonds to house. Where are they skewed? Where's their business, their cash flows? What are their cash flow needs, the college tuition, so forth? We always shock them with this. Are you prepared for 10% interest rates? And the answer is what? And so once again, I think it's important as risk managers, you're a risk manager in some ways, and I am too, to consider the possibility and to make sure that we're all protected from this potential outcome. And I can make a very strong argument that it's coming. Jay Powell. So we're going through the four grand kingdoms now: monetary, fiscal, trade, and regulatory. And I'm going to skip through a little of this. This is the Fed's balance sheet here. You can see in 2008, with the great financial crisis, they embarked on some novel schemes to inject money into the system and save the modern world. And they got us out of this deep recession, which, by the way, was created by government policies. You probably want to hear about that, don't you? So the great financial crisis, when you read the press and you listen to the pundits, you'll find that they're blaming greedy bankers and investment bankers and capitalists. But I will come to the defense of those people and tell you that they largely play by the rules. Enron didn't. WorldCom didn't. They're obviously exclusions, but they largely play by the rules. The government defines the rules. Back in 1996, under Bill Clinton, the federal government changed the rules governing lending by banks under the rubric that they were being racist in their lending standards, lending to minority populations to a lower degree than they were the white population, for instance, and they called it redlining. It was a term whereby they thought it was racist rather than risk control. And so they forced them to lend to these subprime borrowers. They enacted something called the Community Reinvestment Act, CRA, and the CRA pried open lending to subprime borrowers. These are borrowers that shouldn't be borrowing, by the way, or shouldn't be borrowing great sums of money. And yet the government forced it open. They forced banks to take that risk, and banks, of course, had to do it. I remember distinctly they trotted the president and CEO of Bank One in front of the Senate Banking Committee and referred to him as a racist, wagged their finger at him, and then they passed this legislation. They opened up a new line of business for banks, which is to lend to subprime borrowers. And boy, did they do it. It became a cottage industry. In fact, it became a huge area of profits because, as you know, you can charge more for a loan to a subprime borrower than you can to a credit borrower. And I mean, that's a fact. Subprime loans, they charge 20% for currently. So it became a bonanza, a money grab, by the way, created by a change in government policies, which not only made it okay to lend to these people, but encouraged it. And not only encouraged it, but threatened punishment if they didn't. And of course, greedy capitalists that they are, they went after that market and started making all this money. And they created these products, which were collateralized loan obligations, CLOs, where they take 1,000 subprime loans, package them into one large security, and then a pension or a foreign government, sovereign wealth fund, even individual investors would buy these or invest in these securities. The idea was if you had 1,000 borrowers spread across, then the risk was minimized. It wasn't minimized, obviously, right? And there were so many mortgages in these baskets, in these securities, these CLOs, that nobody even knew what was in there. So either way. Oh, by the way, and then you had Fannie Mae and Freddie Mac. Fannie Mae, the federal national mortgage lender, they backed all these mortgage loans. There's a lot of talk at the time about the, what do they say, implicit guarantee from Fannie Mae. I went and read their charter, which was, by the way, painful. And I found not an implicit, but an explicit guarantee in the language. It was not implicit, it was explicit. It basically said, lenders, go make these loans. We got your back, dollar for dollar. So lenders did it. They were making so much money, it became a casino. And then you had the great financial crisis. Without the Community Reinvestment Act and without Fannie Mae backing it all with an explicit guarantee, it never could have happened. So when I earlier said booms and busts don't happen in a vacuum, that in a freely functioning, purely capitalist system, purely free market system, those kind of things, those kinds of imbalances don't happen. They're adjudicated. I could do a whole webinar on that concept, by the way, but I know you get it. You understand that. The government doesn't, or they don't care. Okay, back to this. Here we are. So the government policies create this high risk environment, which blows sky high. We create a long, deep recession. And what does the government do? Come to our rescue with this giant money printing scheme from the Federal Reserve. Then, because the economy refused to grow fast enough, Barack Obama was elected in 2008. Ben Bernanke was the Fed chairman. Because it wasn't growing quickly enough, they enacted other novel monetary tools called quantitative easing, QE. You've heard of it. QE 1, 2, 3, 4, and cynically QE infinity, which is where we are today. And so during this period of time, when we weren't in a crisis and we were not in a recession here from 2010 to 2013, because we weren't growing quickly enough, The Federal Reserve increased the money supply substantially through these quantitative easing programs to try to goose the economy because it was becoming a political problem that we weren't growing fast enough. It was the weakest recovery out of a recession in US history. It's so foolish, by the way. So here we are, QE, woo, ripping higher. And so we had the Federal Reserve's balance sheet go from about less than $1 trillion to $4.5 trillion in a period of 2008 to 2014, as you can see. So 6 years and a quadrupling of the Fed's balance sheet. Let me talk about the mechanism for how they do this. When they increase their balance sheet, they create money out of thin air, digital dollars. These are dollars that are not in circulation. And they buy treasury bonds, a massive market, as you can imagine. We have $36 trillion in federal government debt outstanding. So there's $36 trillion of treasury debt outstanding on bank balance sheets, by the way. As you know, a bank can't make a loan unless they have a reserve behind it. So they have to own these treasury bonds, which are perceived to be and ordained a risk-free asset. So they can own gobs of them, and they're required to by law, in fact. When the Federal Reserve increases the balance sheet, here's the mechanism. They print this money. It's digital money. They buy treasury bonds from the money center banks. The money center banks are the very big ones, as you know. There's like 29 of them. It's JP Morgan, Bank of America, Wells Fargo, Royal Bank of Canada, Hong Kong Shanghai Bank, HSBC, Goldman Sachs, Morgan Stanley now. These are money center banks. And they buy these treasuries from those money center banks. And here's a perversion. The goal in this program is not to get a good deal on those treasury bonds. They're like any security. When you and I buy a stock, we want to get a deal on it. When we buy a house, we want a deal. When we buy any big ticket item, we want to get a deal. We want to buy it in the whole. We want it cheap so that it'll go up in value. Think about this. When the Federal Reserve buys treasury bonds from JP Morgan, they don't want a deal. In fact, they want a higher price. They want to pay more, not less. It goes against every rule of investing, but that's not what they're doing. They're manipulating. They're trying to manipulate prices. They're basically trying to control yields. And how do you control yields? How do you keep yields low? Remember, yields move opposite of price in a bond. You bond price up, yield down. Bond price down, yield up. So their incentive is they're trying to lower yields. So they're trying to pay up for the bond. So they're not trying to get the deal that we would get or want. They're trying to pay up for it. So just think about that for a minute, what a perversion that is. But that's what they're doing. And it doesn't matter because they printed the money. They didn't make it. They didn't earn it. It's not after-tax income. They created it. It's a digital dollar. They wasted it. The design was yield curve control. The design was to keep yields low to try to increase GDP, growth, production, etc. That's the mechanism. So what does that dollar do? So when they increase the Federal Reserve's balance sheet by here, 3 trillion to 4.5 trillion during the period of 2013 to 2014 and change. When they increase, call it $1.3 trillion, when they increase the balance sheet there by $1.3 trillion, they take that money and they buy treasury bonds from money center banks. What they're doing is they're injecting money directly into the capital markets. What's that? Stock market, bond market, real estate, private equity, the capital markets, investment markets. And they buy those bonds from JP Morgan and the other banks. They're injecting newly created money into the main aorta of the capital markets, hoping that it will matriculate out into the vascular system and into the capillaries of the economy. The economy is a system just like your body, actually, functioning just very similar. And it's a complex system where the head bone's connected to the neck bone. You may remember that little rhyme from elementary school. It's very similar. These are systems, and they're injecting the money into the main aorta of the capital markets, hoping again that it will go out through the veins and in the capillaries, and it'll boost production, that it'll lift economic activity. And it's very risky. It is also a blunt object. To think that they can micromanage economic growth through money supply is absolutely, I would say, arrogant, assumptive, and well, it works, but at what expense? I'm going to go through that next. Okay, so back to 2020. You can see here the government created meltdown, which is the COVID crisis. I know it was a pandemic. Yes, you're correct. But the government made it many times worse. It just came out, by the way, that Mario Cuomo or Andrew Cuomo, was it? Yeah, the governor of New York is being now sued for taking all those old people, taking and keeping them in the nursing homes, and something like 1,500 elderly people died. The government response was panicked, is an understatement, out of control, way too much. And they created this. They created the crisis, just like they did back here in 2008 with the Community Reinvestment Act, and so forth. So here they come to the rescue again by increasing the balance sheet from 4.3 trillion to $9 trillion. They did that again by investing money, buying treasury bonds, injecting the money into the system. And that's why my house is worth over 4 times what I paid for it. That's why the stock market is trading at all-time highs on a daily basis. That's why commercial real estate and the apartments and all these financial assets are at all-time highs. It's because, again, they stimulated the capital markets through money creation. You can see here where they're trying to shrink the balance sheet now. This is overdue, by the way, but because this is inflationary. Remember, when we go back to Milton Friedman's inflation is too much money chasing too few goods. Here's the too much money. And they're obviously they're shrinking the balance sheet. And the way they're doing that is letting the bonds roll off, and they're not renewing them. So when a 2-year bond expires, they're not re they're not reissuing the bond. In other words, they're shrinking the money supply gradually. It's what they should do. It's deflationary, but darn it, it's not working. And the reason it's not working is this lady, Janet Yellen, the most political Treasury Secretary in modern history, maybe US history. She did something that's very rare. She went out on the campaign trail stumping for Kamala Harris recently. That's maybe never been done in US history. The Treasury Secretary, like the Federal Reserve Chairman, has to remain apolitical. They have to remain above the fray because they are so important to not only our economy, but the world economy. They're so powerful. So as the Federal Reserve was shrinking, still is, their balance sheet here, Janet steps in and increases spending substantially. We're now running a over $2 trillion federal budget deficit per annum. We take in $5 trillion of tax revenues, we spend $7 trillion, $2 trillion a year. And in the last weeks, just before the election, she increased the federal budget deficit by $345 billion right before the election. I wonder why. What's behind that? Either way, it happened. So they refer to this as fiscal dominance. They've taken over. The Federal Reserve has started shrinking the money supply. It's deflationary, and it's also could cause a hiccup in the stock market or whatever. So she steps in and starts printing money to make up for it. That's what happened. I'm going to go back to let's see here. Sorry. Gosh, we only have 30 more minutes together. I'm already missing you. Recession probabilities. As you all know, everyone was expecting a recession this year, all the major investment banks and their economists, et cetera. And the reason they missed it was we did go into a recession you if you remove this insane deficit spending. If I had a big syringe and I sucked out all that deficit spending, the trillions of dollars of money that was injected into our economy by the Treasury Department through deficit spending. If I sucked it out, we would have already been in a recession. So what the pundits missed was that. We included. We failed to realize that the fiscal dominance, that the fiscal stimulus was going to be so massive that it would keep us out of a recession. And it did. I want to show you this one. Forgive me. Oh, well, I don't have it. I'll go back where I was. 37, yeah. Is it? Yeah, 37% of GDP is government spending. So you know. So let's pretend that I'm president and you all are my cabinet. If we wanted to increase GDP, all we'd have to do is spend more money. What kind of incentive do you think that is for politicians? That's the incentive. And they did it. They did it. So I would argue that government should detract from GDP. They don't create anything, produce anything. They just rearrange it. And there's friction to that. There's a cost to it. Either way, all the bearish predictions of the recession were wrong because they failed to consider how big the fiscal dominance, fiscal stimulus would be, the deficit spending, which is just money, helicopter money, they call it. Stimmy checks, COVID spending of $4.1 trillion. That's mailbox money. So when we talk about inflation, too much money, this is it, but too few goods. One way to create to increase labor costs is to pay people not to work. And that's what this does. When you give people free money, you pay them not to work, which leads to scarcity of labor and higher prices. We all know about how hard it is to find a good worker today. Well, this is why we're paying them not to work. And by the way, when you forgive a student of their student loans, aren't you basically paying them not to work? What greater incentive does a young person have? They graduate from Columbia with a social justice degree and $100,000 in debt. They've got a very strong incentive to take that little mind of mush, put it to hard work to pay the debt off. And when you take that off their plate, where's the incentive to work? We're paying people not to work. It's leading to scarcity of labor and higher prices. It's inflationary. It's too few goods. Then there's the Inflation Reduction Act. What an oxymoron. Created, by the way, by morons. The IRA is awful. And the CHIPS Act, this one makes me the maddest. They took $8 billion of our hard-earned tax money and gave it to the worst semiconductor manufacturer on earth called Intel. $8 billion to Intel. Have you seen Intel's stock chart lately? It looks awful. It's falling. It was down significantly yesterday. Second, third, fourth day in a row. It like 52-week lows and more. They've just announced a layoff of 12,000 people. Their CEO left 3 days ago. Leave it to the government to pick the biggest loser in the semiconductor industry to give their $8 billion to. The government should not be picking winners and losers. They're the worst. They have the worst incentives. It's almost like the Federal Reserve when they were buying those bonds. The incentive was to pay more for them, not less. Do you want that with your tax dollars? I don't. Do you want that with money? Not tax dollars. They just print money. I don't. It's inflationary. All this is inflationary. This is still too much money. Here we have the Congressional Budget Office projections of U.S. federal debt. If you look at this in the year 2000, this dotted line shows the forecast in 2000 was for it to fall, and it didn't fall. In fact, the blue line shows it rising significantly, debt to GDP, and the dotted blue line shows where it's projected to go after 2025. In other words, the debt problem is the problem for 2025. This is why I think we've got a significant inflationary bust coming. Here's paying people not to work. 27% of working age adults are on federal assistance, 49% of children on federal assistance. We're paying people not to work. And then they open up the borders. I'm pro-immigration, but I'd like them to be vetted. I feel quite confident in about 10 years, we're going to have another 9/11, and the people that perpetrate the act are going to be part of this class of new Americans that just snuck across the border. Why do I think that? Because if I were a mortal enemy of the United States, if I was Iran, I would gather my 100 wickedest fighters and send them over here to do the sleeper cell thing that they did prior to 9/11. That's what I would do if I was a diabolical enemy of the United States. And my guess is that's what they did. Either way, I'm pro-immigration. I think immigrants are oftentimes better than Americans. They work harder, they have babies, they go to church. Either way, we're paying people not to work, which is leading to increased wages and scarcity of labor and inflation. Government interest payments. This is just interest on our national debt. Skyrocketing. It's well over $1 trillion a year. This is like me taking out getting money on my Visa card to pay my American Express card. The interest on my American Express card, not the principal. So when we're paying our taxes this year, and you're helping us, I can be pleased to know that a lot of my money is going to interest on the debt that's already been accrued, excuse me. This is amazing. Back to Janet Yellen, the diabolical Treasury Secretary. I encourage you to read about this. Nouriel Roubini, Roubini, is a PhD economist of some note, famous, written books. And he and this gentleman who runs a big investment fund wrote a white paper, where they analyzed a Treasury program that Janet had imposed about a year ago. And this is really worth reading on your Saturday. Here's what they did. Remember, they're having to issue lots of debt to finance, to pay the interest payments on the existing debt. And it's overwhelming the demand for that debt. $2 trillion of deficit spending each year has to be financed through Treasury bond issuance. So $2 trillion of Treasury bonds had to be issued this year and last year. It was October of 2023 when there were several failed auctions. In other words, nobody came to the bond auctions. And that would be a crisis for the federal government if that happened. And it did happen. The way they finance the government is through Treasury bond issuance. They have T-bills, which are short-term in nature. You've got 2-month, 3-month, 6-month, 1 year, 2 year, 3 year notes. Then you've got bonds. Those are 3 year, 6, 5 year, 10 year, 20, and 30 year. The prudent thing to do is finance the government through long-term Treasury issuance, just like it's prudent to take a 30-year mortgage rather than a 2-year ARM, adjustable rate mortgage, which, by the way, in 2 years, you either pay it down or it refinances, whether you like it or not, often at higher rates. So when you finance the U.S. government, this profligate spender, with short-term Treasury bills and notes, it's a lot more risky than financing it through the sale of 20-year and 30-year notes, which you don't have to refinance for 20 solid years. That's easy money. I mean, that's easy math. So what was happening in October of last 23 was that demand for the 20-year notes went away and the 10 years and the 30 years. So in other words, went away. So the stock market started falling. It was like down 13% in a month and a half. We were perking up. We make money when the market falls. We can make money when the market falls. In fact, I had a record year in 2022. But back to the story. So they pulled all those bond auctions in the longer end of the yield curve, like I said, 20 or 30 year, and they just started selling short-term bills and notes, so 3 years and under. And so they saved the day. They saved the stock market. And of course, those auctions went great because who wouldn't buy a 2-year risk-free piece of paper from the federal government that yields 4.5, 4.75? I bought some. I bought my first bonds ever at that single time in that single period in time. First treasury bonds. And they saved the day. But they put us at greater risk because, again, now the term structure of our federal debt outstanding is in 5 years or under paper. That means the entire $36 trillion of U.S. federal sovereign debt outstanding is in 5-year or under duration. It has to be financed within 5 years, all of it. This is wild. It's never been done in the United States. By the way, we've only had these kind of deficits. We've never had them before, actually. The only time it was even close was in World War II when we were fighting 2 wars on 2 continents and winning them. And here we are without a war. ATI, activist treasury issuance. This is a description of what Janet Yellen did in October of 23 when she quit selling the long bonds and concentrated the auctions on the short end and saved the day, putting us at risk, but saved the day. The authorities have very little tolerance for an economic or market downturn. We found that out. They come in with bigger and bigger and bigger programs every time we have a hiccup. It was the great financial crisis. You saw the Fed's balance sheet increase by $1.5 trillion in a minute. You saw what happened in COVID when they increased the Fed's balance sheet by $4 trillion in a minute. What happens if we have another hiccup? They're coming in even bigger, and it's going to be wildly inflationary. This is fascinating stuff. I encourage you to go find this article by Nouriel Roubini, accusing the Treasury Secretary, by the way, of this activist Treasury issuance program. It's great when a mainstream economist tells the truth. Most of them don't. Another thing Art Laffer told me about economists, he says, they're not trustworthy, besides the fact that they're stupid. He thinks it. I've learned it's true. But they're not trustworthy because they will argue until they're blue in the face to defend the position of their political beneficiaries. These people usually don't have real jobs. They work for government or academic institutions, and even they work for the government. And so their primary incentive is to, again, defend the positions of their political beneficiaries. So beware. The government is upside down, but companies have refinanced. I'm sure that a lot of you people, nice people, refinanced your mortgages when interest rates were 0. I did. We all have 3.25% 30-year mortgages now. Companies did it as well. They wholesale refinanced during that period, but the only entity that didn't was the U.S. federal government. They went the opposite direction. They didn't get a 3.25% 30-year mortgage. They actually shortened the duration. The entire 36 trillion, as I am repeating myself, is under 5 years in duration. They took that entire, it's almost like having an adjustable rate mortgage, where a 5-year arm. You're fixed for 5 years. In 5 years, you either refinance or you're in trouble. Consumers are in decent shape despite all the chatter about consumer debt. Smaller businesses depend on low interest rates, and my guess is that we're not going to 0 again, unless it's forced by the Fed through the money printing mechanism and they're bailing out the entire economy after a crisis. And then we could get zero interest rates. But then that basically guarantees my inflation scenario of double-digit interest rates 5 years down the road, just like it did in the 70s. Trade, the least appreciated of the four grand kingdoms. These tariffs are awful, and the trade war is awful. It restricts the supply of goods and services available to purchase. The free trade relationship between China is over. Protectionism is increasing. There was just an announcement that we have reenacted our trade skirmish with both Mexico and Canada. And this is a problem. I know Donald Trump's full of rhetoric, but it's still inflationary. US imports by country, you can see China's in blue, collapsing. This was our glorious free trade relationship with China. And then Mexico's rising, Vietnam and other Southeast Asian nations, we're seeing goods increase. So this is very, very inflationary. The BRICS, Brazil, Russia, India, China, and South Africa, it's a trade bloc. It's expanding dramatically. I don't begrudge groups of countries for enacting a free trade relationship among themselves, but this one's become belligerent. They've added 25 nations to it, and it seems to be that we're fracturing a bit. Just like in the early 70s when I described the Yom Kippur War and how we backed Israel, and then there was a real fracturing between East and West. I see parallels here. This is wildly inflationary. Globalization's over, for better or for worse. But I'll tell you right now, it's inflationary. Everybody's asking me about the recession. We only have 14 more minutes. Darn it. First off, the payroll reports, which are weekly and completely bogus. It's just like the CPI. It's terrible. Right before the election, we had this sanguine report on job creation, and everybody was just harumphing that it was a very strong economy. And look at this. I'm sorry, the light's coming in my window, my upstairs office at my home. But here you can see private workers on the red actually fell. And then the number of government workers gapped up by something like 400,000. So right in front of the election, there was a massive hiring spree by the government, and it made the numbers look a lot better. So honestly, I can't tell you whether we'll have a recession. I can't tell you whether the economy's booming. There's too much mixed information. This one that came out today showed fairly stronger than expected job gains, all in healthcare and social services, leisure, hospitality, and government, as you can see, the top three. I would argue healthcare is government because it's government controlled and subsidized. So if you're going to work for a healthcare entity, services especially, it's a government driven industry to such a great degree. So I'm not sure this is that healthy. Look at retail at the bottom, collapsed, even though everybody's saying the consumer's in great shape. There's a lot of mixed signals here, gang. Multiple job holders at an all-time high. So obviously there's people that have to have more than one job. Maybe that's the gig economy. Maybe that's the fact that you can be an Uber driver and work as a waiter. I don't know. But it is a warning flag. Here is recessions often start not long after the Fed begins cutting rates. And as you know, they've cut by 75 basis points here recently. And you can see, I'll send any one of you these charts, by the way. All you got to do is go to Karen and I'll send them to you so that you can enjoy hours with them after you leave me. Purchasing Managers Index is perking up post the election. So this is the PMI. We look at these very closely, regional PMIs and then the national PMIs. And I think that's the election. People are getting a little excited because the regulatory jihad that the Biden administration has imposed on U.S. government U.S. economy is receding. These are positive signs. Manufacturing PMI is now positive. It's been the first time in some time. We'll see if it lasts. And then the worker productivity of the United States versus the rest of the world is astonishing. This is just a sign of American exceptionalism. It's very bullish for the real world economy, the private sector, and it's also based on our ingenuity and our technology. A lot of some of that might be AI, which is going to be a real, I would say, efficiency tool. And then small business optimism, not great here. And then German industrial production. Europe's in a basket case. You know, the French government's basically collapsed. Germany's killed themselves through their green energy programs. You know, 40% of Germany's in power is generated by wind and solar. And so if the wind doesn't blow and the sun doesn't shine and temperatures rise, they're absolutely screwed. So they've basically created, I would call it industrial suicide. Germany is the envy of the world. Their industrial production is. And here's what it looks like. Luckily in Tennessee, we don't have to worry about that one bit. This is our idea of green compliance. So we're kind of lucky here in Tennessee, being just as simple-minded as we are. Markets are at a speculative frenzy, and I'm about to wrap this up. I'm sure you're upset about it. It was a post-election day rally for the history books. In fact, it was the biggest ever in U.S. history, for what it's worth. Americans are holding a record share of their assets in stocks. This is risky. This is retail investors. They always buy at the top. If there's one thing that scares me, there's a lot, as you know. I'm always worried, but this really, really scares me. I'm turning away from the sun here because so you can see my beautiful face. And so they're all in. Americans are all in. Have you seen this kid? There's these meme coins have caught. They've got several terms for them. Meme coins and shit coins. That's a thing. There's an exchange that's been created, more than one, where you and I could spin up a meme coin, and it's not like cryptocurrency where it's on a distributed ledger. It's a very sophisticated architecture. These are like NFTs, non-fungible tokens that were hot in 2021's bull market. This is a kid on Twitter who was basically created a meme coin, launched it on this exchange, and made $30,000 within minutes, and then shut the whole thing down, took his money and ran. This is going on today, going on yesterday. This happened last week. These have zero value. They don't have cash flow. They're not like there's no value to these whatsoever, and yet they're going crazy. I'm almost jealous. I should go create some for my clients, and we could all make hundreds of thousands of dollars, but I won't. This can't last. I'm telling you, we're at the end of the bull market. This is a 3 times leveraged ETF of the S&P 500. Retail investors are indulging in these leveraged ETFs like crazy. It's wild speculation. And then corporate insiders, meanwhile, you can see here are the bottom line in blue, are record sellers of their securities. So while the S&P hits all-time highs, while U.S. investors have a record share of their assets in equities, corporate insiders are record sellers. There's something here. This is wild. I think we're at a precipice, personally. I'll be glad to explain it. Call me and I'll talk to you about it if you want. And here we are, consumer expectations of future returns at an all-time high. It couldn't be better. And remember, though, without federal government spending of $2 trillion, we'd already be in a recession. The private sector has been in a recession. This is money printing. This is treasury money printing. This is helicopter money. And this is exuberance. It's irrational exuberance, as Alan Greenspan was famous for saying in 1996, by the way, which is important because he was raising caution in 96, but the market didn't capitulate till 2000. So I don't know when this market's going to capitulate, but I'm telling you, it's gonna, and it's going to be gruesome when it happens. So this came out the other day. some BlackRock economist came out and said the world economy has exited the boom and bust cycle. We've magically weaned ourselves of economic downturns. Don't you feel better? Let me tell you, I don't. This makes me even more scared because this same comment was made in 2000, March 22nd, 2000. Boom and busts are at an end. We've eradicated, we've weaned the world of cycles and recessions. Not, don't speak too fast because the market fell about 80% 3 months after this was published. So this is to me scary. So people always ask me, what do you like? I like Argentina. It's incredible. Here we are. The US is the most expensive country in the world by market cap here, US market cap to GDP, and then Argentina is the cheapest. And Argentina has this amazing free market reformer by the name of Javier Milei. He was elected a year ago and almost to the day. And if you look at the ETF of Argentina, ARGT is the ticker, you'll see that it looks like NVIDIA. Beautiful increase in the value of the stock market in Argentina as he enacts his free market supply side reforms in a country that has such great potential. It's got 45 million people faithful. They have babies. They go to church. They're good, solid people. It's a Garden of Eden. They're rich with natural resources: corn, soybeans, wheat, hay, cotton, poultry, pork, beef, zinc, nickel, all the stuff, gold, silver, natural gas, oil, penalized by bad government for decades. And now they have this guy. I encourage you to go Google Javier Milei and listen to his speeches. You'll know that there's an emissary on earth. There's a free market reformer with a PhD who's articulate, reasoned, well-reasoned, impassioned, and exercising real free market reforms in a country that is a petri dish for Marxism. And we're going to watch before our very eyes whether these policies work. We'll just look at ARGT and compare it to EWW, the ETF for Mexico, or EWZ, the ETF for Brazil. Both of them are falling. Argentina is increasing. Diamonds, lab-grown diamonds. When I look at value stocks, I'm thinking I'm going to raise some money and go buy antiques. No kids want antiques anymore. I'm going to go buy a warehouse of antiques and real diamonds. And then I'm going to basically set up a trust so that my children can't sell them and wait 2 generations. And because of just sheer scarcity, these things are going to be worth a fortune. OpenAI, everybody's asking me, what do you think about it? Well, of course, it's amazing. I see AI as a real cost saver for government. I'm moving away from this light. Forgive me. I see artificial intelligence as a real efficiency gain tool whereby you could supplant like white collar workers that do just kind of rote tasks. I don't see the revenue opportunity. I don't know how they're going to charge for it. I'm using Perplexity, OpenAI, ChatGPT, and Perplexity is my favorite. I hope you use it. It's amazing. Better than Google search by far. I see it as an efficiency gaining tool, but I don't see the revenue model, despite they're going to spend hundreds and hundreds and hundreds of billions of dollars building AI models and data centers. And the CEO of OpenAI just came out and predicted that he's going to have $100 billion in revenues in just a few years. I don't see it. I think they're using a newfangled way of doing this analysis to reach that conclusion. And here it is. I think they're smoking something. You can't ask questions unless you reach out to me. So I encourage you to do it. That's my email address. I'm on Twitter. I'm sassy on Twitter. There's my website, trustcomgmt.com. Karen Eversman is my friend at TSCPA and your friend too. You can reach me if you want if you want the articles, if you want my chart book, or if you have specific questions personally. I will not charge for it. And don't forget, if you have some clients who need superior thinking, risk analysis, great service, veteran, nice people like us, please keep us in mind. And that's all I ask. So my time is up. I've been with you for an hour and 40 minutes. I hope it was as exciting for you as it was for me. And again, you can reach me anytime. Bye bye.